All right, everybody, welcome back to Strongman Personal Finance. Do you think that you know how to analyze investments? Do you think that you're an investing genius because you read an article on Robinhood and now you know everything there is to know about buying a stock? Well, let me tell you what, there's two ways to analyze a stock. You can do technical analysis, where you look at stupid charts, which is dumb, or you can actually do fundamental analysis, where you actually look at a company's books, their balance sheet, their income statement, their statement of cash flows, and their statement of changes in stockholders' equity, and you look at trends over time to kind of estimate where the company is going to go into the future, okay? I'm more of a fundamental investor. Well, really, I'm an index investor. But if I were to buy individual stocks, I would use fundamentals because they're not based on 100% guesswork, like looking at charts, okay? There's actually a foundational reason, and you can look at trends in changes in revenue, operating expenses, operating income, net income, all of that over time to see where a company might actually be going, okay? So today, we're gonna start and we're gonna explain to you what a balance sheet is if you wanna actually do some research into the company that you're gonna invest in, okay? Which you should be doing. So if you like the video, if this informs you, if this makes you a better investor, hit the like button, subscribe, and welcome to my channel. Let's begin. So the first financial statement we're going to talk about in these multiple lessons is the balance sheet. What is a balance sheet? All it is a snapshot of a company's assets, liabilities, and equity at a specific point in time. What are assets, liabilities, and equity? Assets are things that you own that will provide you some kind of future benefit or cash inflow, like cash, like an account receivable, etc., etc. What is a liability? It is something that you will have to sacrifice future earnings for, or you'll have to sacrifice cash or some other asset to reduce them or expend them. Think about an account payable, a wages payable, any kind of debt or something that you owe. So assets are something that you own, cash, yada, yada, yada. Liabilities are something that you owe that you're gonna have to eventually pay off. And then stockholders' equity is the residual of what is left over if you subtract your liabilities from your assets. Now, who are the stockholders? Those are people that invest in the company, kind of like you. So this information is really important to understand because it lets you know where your company is at in its most recent financial statements. Now, the beautiful thing about publicly traded companies is that they are audited, which means once a year, a professional firm of auditors comes and they make a reasonable guess on whether these financial statements conform to generally accepted accounting principles. So every year, you can hopefully trust these auditors to give an opinion that these financial statements are reasonable. Sometimes the auditors are completely full of crap, as we've seen in the past, but at least you have some kind of assurance that these numbers are accurate. Because who makes the financial statements? Managers. How do you trust the managers? You don't really. You need an external force to come in and audit the books. Those are the auditors. So when you're looking at a balance sheet of a publicly traded company, there's a reasonable expectation that these numbers are accurate and that you can actually rely on them to make investment decisions. So, like I said, there are three main accounts in the balance sheet. You have your assets, and they are equal to the total of your liabilities plus your stockholders' equity. So if these are out of balance, there's something wrong on the financial statements. You should add up the total assets and they will equal the total liabilities and stockholders' equity. Always, 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 always. So let's talk about assets a little bit more. I already explained that there's something that a company owns, and it's pretty common sense. If you have cash, that's your cash. If you have a car, that's your car. If you're running a business and you have equipment, that is your equipment. Now, you may pay that equipment with your cash and not take out a loan to buy it, or you take out a loan to buy it. And that's how you update your liability account. So, your assets are listed in order of liquidity. So as you're looking down your assets column, there's going to be a bunch of different accounts, and there's going to be a numeric value next to it. These are listed in order of liquidity, which means how fast you can convert that account to cash. So for example, how long would it take you to convert cash to cash? 0 seconds. It already is cash, right? Or a cash equivalent. An account receivable. What is that? That is something that somebody owes you. So if you sell a product and somebody swipes the credit card, that is an account receivable. You are owed payment for that product. You deliver that product so you can mark it as revenue or sales, but they haven't paid you in cash yet. That's an account receivable. You're going to get that pretty soon. Usually accounts receivable are 30 days? Next, marketable securities. What is a marketable security? Basically, if a company's out there buying stocks for the short term, or they have short-term investments, that's a marketable security. Can you liquidate that pretty quickly? Yeah, if the company needed cash, when the market opens on Monday, they could frickin' sell their stocks and generate cash to pay liabilities. Inventory and prepaids. Inventory is something that you're selling. So if I am Ford, I sell trucks and cars. Your inventory is the frickin' trucks and cars that you make. And when you sell them, your inventory comes off the books and you can record revenue, which goes on the income statement. And then prepaids. A prepaid is something that you pay in advance. Let's say that I am renting out a factory. If I pay 12 months of the rent payments up front at the beginning of the year, that's a prepaid. And then over the year, I actually recognize that expense and I amortize that expense over the course of the year. But it's an asset because you've paid the expense up front, even though you haven't truly incurred the expense. But as you incur the expense, then you get rid of the prepaid over time and convert that to an expense. So that's what a prepaid is. You pay something in advance. Property, plant, and equipment. Property, plant, and equipment are the things that you use to store and produce your products. So if you're Ford and you're manufacturing trucks, all your little machines that are assembling in the plant, that's part of your property, plant, and equipment. That is an asset. That's something that you own that helps you generate cash flows. Next, notes receivable. That's more of a long-term debt that somebody owes to you. Now, an account receivable is for like a short-term sale. You know, hey, I just sold you this truck. You have to pay me in 30 days. A note receivable is more of a long-term debt where you're going to be collecting interest, but you're not going to get the principal back for a long period of time. And that's usually to help your customers finance longer projects. And then finally, we have goodwill. Goodwill is an intangible asset. It is not something that you touch. It's not something that you use. But what it is if you buy another business at a higher amount than its value, that excess amount that you paid is your goodwill. And you actually have to account for that on your books, okay, to make the equation balance. But if the company that you're looking to invest in buys another business or a brand, they're usually going to pay more for it than the value of the company because they believe that that brand will generate more money than what they're paying in the future, right? You wouldn't buy something for $500,000 if it was only worth $250,000. But if the price was $250,000 and you spent $500,000, you're probably assuming that $250,000 can grow and generate more cash and more value for your shareholders over the long run. So that's what goodwill is. It's an intangible asset. It's not something you can touch. Now, these are your assets. You total all these up, you get a number, and that equals your liabilities plus stockholders' equity. Going on to your liabilities. These are organized in order of maturity. So the top of the list is going to be what's due first. And then as you go down the list, that's more of your long-term debts. So like I said, a liability is something that you owe. You're going to have to expend resources or cash or forego receiving resources in order to pay these off. These are your debts. The company owes these debts. You have current liabilities, which are assets or liabilities that are due within a year or less, and you have long-term liabilities, which are due in a year or more. Now, a key thing to note when you're looking at your company is you want to compare your current assets, which are assets the company expects to convert to cash within a year, and compare that to your current liabilities. Because if you think about it, in your company, they owe money and they're going to have to pay a lot of money or a certain amount of money within a year. But if they don't have enough current assets to cover those debts, they have the potential to default and not be able to pay their debts. So you want to compare your current assets with your current liabilities. And your company better have more current assets than current liabilities, or there's going to be a big freaking problem. Or the company's going to have to go into more debt to cover their current liabilities, which is not good. So that's a key thing you need to watch out for. Anyway, liabilities are sorted in order of maturity. Whatever is due first is listed first. So an account payable, if you're buying inventory on account, you're not paying cash for it, you're swiping your credit card, that's an account payable. That's due pretty soon. You're going to have to pay off that credit card that you swiped very quickly. Wages payable, got to pay your employees. Usually it's every couple of weeks, you got to pay them. Taxes, you have to accrue your taxes that are payable each year. Interest, yada, yada, yada. There's a ton of short-term liabilities that you have to record on your books because you want to know what you have to pay and how soon you have to pay it. That's very important. Current portion of long-term debt. Now, when you're paying long-term debt, let's say you take out a 20-year loan and, like a mortgage, for example, and you're paying your payment every month. Part of that payment is principal that pays down the loan balance, and part of that is interest, which is just you giving money to the bank or whatever. Now, that principal that's due within a year, that is the current portion of a long-term debt. That mortgage is due over 30 years, 20, 30 years, whatever, but the principal for the first year is due within a year. So you have to annotate that as current portion of long-term debt. Next, we have notes payable. These are longer term debts. Maybe you're paying interest every year, and then in the last year, you actually pay off the principal. And then you have long-term debt. That's really long-term debt, like bonds payable, et cetera, et cetera. Just know that your liabilities are sorted in order of maturity. If they're at the top, you're going to have to pay it back. And you want to look at a company and say, hey, how do their current assets compare to their current liabilities? Can this company meet their bills? Because even if somebody's talking about, the next hot thing, and, this company invests in AI or whatever, if the freaking company doesn't have enough current assets to pay their current liabilities, they're going to go bankrupt or go into more debt. So it doesn't matter necessarily what the company's investing in or producing if they can't pay their freaking bills because they're going to go bankrupt. And that's something you need to look at. Now, ideally, you want a company that has not a lot of liabilities, but has a lot of assets and equity. But that depends on the industry and what type of company you're investing in. So when you're looking at a company and you see a lot of liabilities, let's say it's an airline, well, guess what? Airlines generally have high liability balances because they have to buy the frickin' planes and then pay them off using the revenue of their flight sales. So when you're looking at a company, you want to compare the debt to asset ratio and all the other ratios, current ratio, whatever. You want to compare that to the industry. So if you're looking at buying an airline stock, you want to compare the airline to the industry. For example, I bought Southwest Airlines. Not saying you should, but I bought it right when the pandemic started. And one of the things that I looked at was how many current assets the company had versus its current liabilities. And compared to the airline industry, Southwest had a better current ratio, or they had a ton of current assets versus their current liabilities, which told me they were more likely than other companies to survive if they didn't get a bailout. So make sure you're comparing your companies to the industry that you're investing in. Now let's talk about stockholders' equity. Now in your company, you have assets, and they equal your liabilities plus your equity. Now, there are two people that have claim, or two groups of people that have claim to your assets. Your liabilities, whoever's lending you money, has a claim to your assets if the company were to default, go out of business, or get liquidated. And you have the stockholders who also have claim to a portion of the assets. So some of these assets are financed, which is the debtors, the liabilities, and some of these assets are owned free and clear by the shareholders. And these ratios, these differences tell you who has a claim to these assets. Some of the debtors have claim to these, and the stockholders have claim to the remaining assets. All right? Now, stockholders' equity. That is your actual ownership interest in the company. So, there are different accounts within the stockholders' equity account. You have preferred stock, which is stock that pays a fixed interest rate. You have common stock, which you should be buying or investing in the long term. That's the stocks that are actually out there trading on the market that are very common. And you have additional paid-in capital and retained earnings. Now, going into a little bit more detail about how these stocks work. When a company needs money, they issue stock. The stock has a thing called a par value, and then it has a market value. Usually stock par values are $1 or some derivative of $1, moving the decimal point. When a company issues stock, they record the issuance of that stock at the par value, but if they get more money in excess of the par value, which they almost always do, that is recorded as additional paid-in capital. Now, a company only has a certain amount of stocks that they are authorized in their corporate charter to give out to the public. That is the authorized amount of the stock. Once a company actually gives out the stock to the public in exchange for cash, that is issued. But a company can actually buy back the stock that they have issued out to the public, and that is recorded in treasury stock unless it's retired. That is your outstanding stocks. So if you're authorized 1 million stocks in your charter and you give out 500,000, you have 1 million authorized and 500,000 issued. That's out in the public. But if you buy back 200,000 of those, then you only have 300,000 outstanding, even though you have 500,000